to be honest, I haven't read them, though I could probably do it
Yeah,
in 15 seconds.
yeah, so leaving them until Tammy is back is probably
Yeah,
the
so
best
let's leave that till the
Yeah.
next meeting when we can get two people that were there and read them.
Yeah.
So we are right into adopted budget and annual 311. So Erica, I look to you, and you can look to anybody else you want
Yes,
to.
I'm going to look to Jesse, and I believe Candace is logging in right now, so I'll go to Jesse.
Thank you, Dr. Jonas, and good evening, trustees. So I'm going to kick off this evening before Vice President Jones will be with us shortly. So I'm going to kick it off with presentation for the annual 311 report. So let me go ahead and share my screen.
Is this the report that Mary sent us? Yeah. It said annual report.
Correct. So what Mary sent you is the actual report, which is, it looks kind of like this. Oh, sorry, I have a screen blur, so it's not letting me. But it is a report that is 48 pages long. So it's quite lengthy. So what I hope to help everybody through this report is to pinpoint the pages that are mostly focused on and things that are heavily looked at. And then I will open the floor to everyone to ask questions onto detailed pages. So if that's okay, I would like to start with page 2. So the first page is the cover page, which is an introduction of who we are, and the signature page. So starting from page 2 is actually a pretty important page. It's called the 50% law. So by law, at least 50% of our expenses has to be devoted to instructional activities. So we perform this calculation each year after the book has closed. So this calculation will walk you through from page 2, page 3 to page 4. So the page I'm presenting, highlighting right now is page 4. So it shows that we are in compliance with the 50% law by having a 50.29% of expenses devoted solely to instructional activities. And starting from page 5 is a demonstration to the general fund balance sheet numbers. So on page 5 and page 6 are for general fund, restricted and restricted. Each restricted and unrestricted fund has its own column, and also it has a combining column showing the total for the entire general fund. And starting from page 7 to page 21 is the balance sheet numbers for all the other funds. And detailed revenue and expenses starts on page 22. And this is quite lengthy because it goes by each of the funds and each line item of where we are. And especially for general fund, it goes really down to the very detailed level. For all the other funds, it shows a summary level by each of the account type. And the next really important report is the GAN limit report. So you will actually see an action item on next Wednesday's board meeting. So this is kind of like a preview of what will be there. So the GAN report is a calculation of what our appropriation limit would be for the next fiscal year. Well, actually for this current fiscal year, 22-23. So this will limit us to the total appropriation that we are allowed to have from all tax sources. So this would be from our general apportionment, also from property taxes and those type of sources. So based on that calculation, our appropriation limit for this fiscal year is projected to be $168 million. And the
just
next,
as a reference, we're going to get to the adopted budget. What's in the adopted budget for appropriations?
Correct.
No, compared to 168 million, what is the actual amount we're budgeting?
Right, we will get there. The actual adopted budget will also have local sources, which are not part from the taxes.
I was just trying to get a reference if it's my understanding, usually the GAN limit is so far up there that it's not like it's nothing that we usually have to worry about, is my recollection.
Correct. You're absolutely right, Trustee Martin. And this year, actually, the calculation changed a little bit. The law changed. So in the previous years, we were given a really high limit, so we never really have to worry about exceeding the appropriation. So the latest change in regulation changed the top part of the calculation. So the top part actually started off with our appropriation from the previous fiscal year and adjusted for inflation and also actual enrollment. So you'll see that our appropriation limit on line H is higher than the calculation, which is on line G. So this will be a different from the previous one that we've done. And so what the Chancellor's Office have communicated to us is that any excess between line G and line H will be automatically transferred to the state. So that would be any excess in appropriation that we need as a district will be transferred to the state.
So again, the simple question was, when, spoiler alert, when you look at our adopted budget, what is our appropriation? How much is it?
Correct. We'll get there
Okay,
with Candace's presentation.
we'll wait till you get there.
Okay.
We'll try to remember 168.9.
Okay. The next quite important page is EPA, so Education Protection Account. So this account is solely devoted to instructional activities. So the calculation is actually this amount is a part of our general apportionment, and we're happy to report that the whole 57 million is 100% devoted to support instructional activities. And the last very important page is the cost of pension. So for fiscal year 21-22, these numbers that are presented for STIRS and PERS represent the actual contribution Pasadena City College has made to support pension costs and for faculty and classified members that are with our district. And for fiscal year 22-23 on to 26-27, these are projections calculated based on the latest estimate provided by CalPERS and CalSTIRS. So it can kind of give us a snapshot of what the increase in escalation in costs would be.
So the difference in the budget that we're looking at in 10 minutes or whenever, the CalPERS, the CalSTIRS has increased by 19.3%.
Oh, this
3.5 million, right? Which is 19.3% is what we've anticipated in the new budget compared to this year that we just concluded.
Correct. This is how the formula is set out to be. We don't really need to, we don't have a way to dictate how the formula is. Actually doesn't work out exactly that way, just because if we move up a column for 21-22, there's no amounts there. So it gives a kind of false comparison into the next year, 22-23. But the rest of the years in comparisons is much more to the reality. So in essence, the 19.3 is just how the Chancellor's Office set up the calculation to be, but it's not a true representation of the increase in cost.
Well, okay, because that 3.5 million is actually a number I did notice in the budget you gave us. I mean, I happened to look for that number and just noticed it was sizable, like around 3.5 million increase in 22-23 over actual 21-22. In 21-22, wasn't there some offset the state provided us?
Yes, the state provide, let me address the first question first. So the 3.5 million increase, that number is accurate. So my previous statement about the 19.3, that is that calculation is not exactly accurate just because of the formula that is set up in the system, but the 3.5 million increase is accurate. So yes, the state every year will subsidize us, will help us pay for a portion of our CalSTRS cost. So we call it the pass-through payment. So the state actually paid it on our behalf. I believe this year is over $7 million. So it's very close to 8. We budgeted 8, so it came in about a little over 7. So it doesn't actually hit our bank. It's the state that paid it on our behalf directly to CalSTRS.
Is there any hope of that in 22, 23?
We are actually hoping that this contribution will continue. We have not heard otherwise. So we did count towards that in our budget.
And, okay. All right, thank you.
And that actually concludes my presentation for the 311. So any other questions?
Quick question, just on that pass-through payment part for STRS, could you explain that just a little bit more as to why that existed?
Oh, sure. So the state has allocated a portion of their expenses to help kind of alleviate the burden of the district paying for pension costs, because pension cost is quite high. So we can look at the history. So for 21-22, CalSTRS employer contribution rate is 16.92% of payroll, and CalPERS employer rate was 22.91%. And that's going to continue to grow. For 22-23, for example, CalPERS is actually going to grow by almost 3% to 25.37. So the cost is adding up, and the state does recognize that it is a huge burden on the district. So they are allocating a portion of their expenses to help directly reduce the amount that we as an institution needs to contribute.
Thank you.
You're welcome. Any other questions?
I don't have any other question, but just a high-level comment for Alton and Steve. So, and then the staff can correct me if I don't quite get this right. But basically, we're required by the state to quarterly file a finance report on that quarter's finances and what was actually spent versus budget. And it's affectionately known as the 311Q. And not in her colorful chart here, but in the document they gave us in the 48 pages or whatever, you will notice it's perfectly designed, I think, for some computer to maybe get it the way they want it or something, but not for humans to really read or understand. So sometimes we get a one-page summary that just kind of says this is what's been spent, and per budget. I didn't exactly see that in this one. So it's a lot, in my opinion, of convoluted numbers to try to tell the state on the report they want what we've actually spent. So that's kind of one of our purposes of this committee, is to review that in a little more detail so that the full board doesn't have to. So I think that's what we saw going on here. This is probably the most important of all the 311Qs, because this is the fourth 311Q, or the final one for the whole year. So this one was probably a little more important than some of the others. We don't necessarily have to hang on every number on every quarter, but when we get to this one, it kind of counts. Anything else you'd want to add to that, Candace, or anybody else?
You got it. Yeah.
Yeah.
This
Okay.
is our big one. So you'll see, to Trustee Martin's point, like our November 311Q, well, it's like our beginning sort of quarter of the fiscal year, and so we don't tend to see a lot there, right? And sort of like this is our conclusion after we close the book. So you're spot on.
All right. Is there any action you need us to take on this?
I believe we will need the board to take the committee to take an action to recommend for the full board for approval.
Okay, and so we're gonna accept Steve as the de facto alternate Budget and Audit Committee member for this meeting. So if you want to vote Steve, you can. If not, maybe Alton and I can make a quorum and get enough votes to pass it for recommendation to the board anyway. So entertain a motion.
So moved.
Okay, thank you, Alton. Stephen, do you want to second it or I'll second it?
So yeah, just for being clean,
I'll
I
second it.
strongly recommend that only the committee members who have been assigned to the committee.
Okay.
Other districts actually identify alternates, and so that might be something we want to have the board explore, where we officially name an alternate. In this case, the LACCD used to do that all the time. Each one of their board committees had an alternate listed.
Point taken, Erica.
Yeah.
I'll second
Anyway,
it.
yeah, so I would say let's keep it as clean as possible. 'Cause
Yeah,
it is-
and so, and I guess technically, I don't know if Emmanuel is part of this committee or just joining as a good board member.
He is not, yes, he's joining you as a board member. Under the Brown Act, a student trustee does not contribute to quorum.
Okay, but my point is, do I get an advisory vote from him because he's officially on this committee?
No.
Okay, so unless you want to comment, Emmanuel,
And I will double check that. Okay, just so you know,
Okay.
Emmanuel, I will
All
double
right.
check that.
well, we're happy to receive comment from you if you'd like to comment, and if not, then Alton and I are going to vote on this recommendation, the motion to recommend the 311Q to the board. Okay, seeing no further discussion, all in favor, please say aye or raise your
Aye.
hand. Aye. Okay, so that passes unanimously of members present. So now we will go to our adopted budget.
All right, trustees, let me share my screen. All right, so we have our proposed adopted budget for 22-23. We'll give you some quick highlights and then run through some of the data points. Please, at any point, if you want to pause, we can always pause and certainly take questions while we're on a particular slide. All right, so just a quick sort of run through as it relates to the budget framework. Just remembering that the governor's budget, initial budget comes out in January. That's sort of the proposed. There's lots of activity and advocacy that happens between January, certainly, and that June time period where we receive a May revision in terms of what was projected or at least anticipated in January, a May revision, and then a final budget in the June timeframe. While I say final, sort of signed bill, there's lots of trailer language related to funding and how funding will be distributed that follows that in July, August, and sometimes even into September. So while there may be items that pop up onto the governor's budget, we may not know a lot of clarity around how those funds would be distributed until a little bit later or months later, and they sort of take them in order. We receive a compendium that gives us guidance as to when we'll receive some guidance on audit requirements or how calculations will be handled. So while there are a couple items here that we're still waiting on some trailer bill language, we certainly have a solid framework to build our adopted budget. The 2022-23 budget framework for community colleges provides about $4 billion in Prop 98 augmentations over the prior year, which is over the 21-22 budget year. I always have to get that right in my head. And then 1.9 billion are provided in ongoing resources. So we will see those contributions happening every year. And about 53%, 2.1 billion of the funding is in one-time funds. So we're particularly always curious about one-time funds. We don't get our hearts completely set and all bought in, because remember, one-time funds go away, but they are really great investments to allow colleges to start up programs or continue to invest in really interesting ways. So we're really happy about that contribution. The enacted budget also includes a 1 billion, a little bit over $1 billion in ongoing adjustments, which affect our student-centered funding formula. So our base calculations adjusted a bit at the very last minute, but they did adjust in our favor. So there were some adjustments, and a part of that piece includes for the system some designated funding for adjunct benefits. That's the bill that we're still waiting some trailer language on, as well as so for part-time faculty health insurance, and 26.7 million to sustain system-wide enrollment growth. So those are kind of like the big pieces. A visual look at that is this. At the top slide, the top bar chart is ongoing investments, and the bottom one is one time. So just sort of talking in terms of what the contributions have made. There have been contributions, ongoing contributions for COLA. I talked about our SCIF, our student-centered funding formula, base allocation, the actual calculation changing. 200 million is going into the system for part-time faculty benefits, some enrollment activities in terms of helping outreach and including sort of retention and recruitment efforts, succession completion grants. So it's really exciting that the state is making, you know, me, Jesse, we like to see ongoing funding, right? We love, Dr. Andrew Jonas loves to see ongoing funding. It's tough when we get one-time funding, but those are where the contributions have been made. The one-time investments are really significant and actually really positively impact the district as well. So there's this really large investment in deferred maintenance dollars that are going to be distributed amongst the colleges. And that's really important because this year and last year was like the first time in many years where we had received significant money for facilities and deferred maintenance types of items. And so we like that contribution. There is a good investment around this COVID block grants, which the college actually recently submitted our application and all of the documentation in order for us to be included in that program. There's some, again, additional one-time funding for retention and enrollment. There's this new comment, well, it's not new, they've been talking about it for years, but continued investment, one-time investments in common course numbering, as well as some adult ed and healthcare pathways, some sort of instructional pieces. So we see that. What I always love I just want to give context because while the state and the chancellor's office has been really, really great about messaging around where there are some additional revenue sources for fiscal year 2022-23, they are also messaging for districts to be very thoughtful about future predicted budget deficits, which they're predicting to hit us in 25-26. So it'd be remiss of me to say, yay, we're getting all this funding, because it's sort of the balance that we need to play as it relates to, there's lots of stories about all this funding. Well, if you look at the state, they're also being telling a cautionary tale related to the Legislative Analyst Office, which is the LAO, that concluded that the state's general fund will likely receive deficits by 25-26. That is when also our hold harmless pieces and provisions go away. We'll have a new base for funding, which we're still sort of working out. And it's regardless of whether the future trend in state tax revenue grows. And the reason why is because the SAL, which is our GAN limit, the revenue as it continues to grow, it also increases the state's constitutional funding obligations that may lead to these deficits. So I did link this, and so when we attach this to the formal board agenda on Friday, we always kind of keep the presentations in draft form in case you all have feedback for us and we need to make some adjustments before Friday. But I did link where I received this information, not only where we get the budget information, and also the information sort of being cautious about what 25, 26 will look for us. All right, so now let's talk about us and what we're going to be doing for 22, 23. Here is our revenue projections, and then of course our expenses. And so if you notice, our state apportionment has increased to 174 million. It's about 86% of our total revenue body. Lottery has gone down a bit because lottery is one of those categories, those revenue streams that actually is dictated by enrollment and FTES. And so because we're down in enrollment, we will see decreases on lottery. And the increases that we see in state apportionment are based on some of those ongoing contributions, like the COLA is kind of embedded in that. State mandated claims is pretty stable. Non-resident tuition, we have also decreased that because we have had some hits on our international student population. So we're trying to be thoughtful about that. That's that $8 million that Jesse mentioned in the 311, that CalSTRS on behalf payment is always budgeted. We budgeted a little bit over where we see our expenses, but that we feel safe about that money. And remember, that money is just a pass through. We don't really hold on to it, but we want to account for it in our books. Have another 8.7% in categorical, student, and other related revenue streams. And then here's where we start to record the lost revenue recovery for our indirect costs on CARES and HERFs. So that's about 1.2 million. So the total unrestricted general fund. So it's not the restricted general fund. This presentation is focused on the unrestricted general fund is $202 million, 206. So a little bit over 202 million. Where we then see our expenses, so that's what's going to come into the college. What's really important that we want everyone, the community to understand, our trustees to understand, is that the bulk of our revenue is assigned to salary and benefits. So we make heavy investments into our people. And so that constitutes a large portion of our budget and our expenses. Of course, we have supplies and materials, some operating expenses. Where you'll see that, if you were able to go through some of the detailed reports, you'll see like that's where our utilities hit, and consultants and those sorts of activities. We transfer a little bit to our capital outlay, and then we have some other outgoing transfers, which constitutes sort of the full, what we're accounting for, that's revenue coming in, and that what we expect to expend throughout the year.
So you're gonna dive in here to the
you want
funds,
to dig
but
into a little
if
bit
you
of
could go
detail?
back there. So
This one, you want me to go back?
yeah, back to that first one. So
Yes.
a few high level questions. So I'm looking on the 19-page adopted budget,
Yes, sir.
and page 4, total general revenue, exactly like you have on here, 174 million, which means to me that I always thought lottery was part of the general unrestricted fund, but I guess it's not. Is it in it?
We have a restricted, that gets shown elsewhere.
Okay.
So lottery this is like our unrestricted sort of lottery pieces, but we have a very large instructional budget that's not accounted for in this general fund.
Okay. My next question is back to my last question under the GAN limit. So the GAN limit was 168.9 all taxed, and our state apportionment is 174. is there a part of the state apportionment that isn't coming from tax? How does that work? What is the answer to the GAN limit question?
Jesse, you want to take that one?
Sure, I'll chime in. So essentially there's multiple components. The apportionment, a lot of it comes from the state, which is from Proposition 98 protection. So that's a big piece of it. And another big piece of it is from our local property tax. And the third big component is from our Education Protection Act. So the three pieces makes up the bulk of what we see as an apportionment. And all three pieces kind of have a drawing effect among each other. So when we have higher property tax receipt and our general apportionment from the Prop 98 decrease a little bit. So, but our whole pie doesn't change. The total doesn't change. It's just the components of where it lands. It kind of shifts a little bit when the other components move.
Okay, so I still don't quite understand because you just got to put it really simple to me. It sounds like we're getting public money of 174 million. And it sounds like the GAN limit that we just heard was 168.
Mm-hmm.
That
Correct.
doesn't seem, if I understand what the GAN limit is limiting, what you just said, something's not adding up for me. And if it's, is there a simple explanation for why it's okay to get 174 million in taxes when the limit's 168?
Yes, I can actually look into because the GAN limit calculation, it only asks for specific accounts from our receipt. So I can look up those accounts for you, and then we'll have a better picture of what is not a part of it.
And I don't need the micro detailed answer. I need the conceptual answer that a layperson can understand. There's this part of the state apportionment that's not considered tax. Therefore, when you remove it, our number is
Go down.
whatever it is, less than 168.9.
We'll pull those for you. That's
You
great.
get what I'm saying? Yeah.
Yep. Great advice.
Yeah, I don't need to get into your detailed accounting on it. Just get the concept why 174 isn't greater than 168.9.
We got you.
Yeah.
We
All right.
All right. So then here's how we close our books. So this is the actual fund balances for fiscal year 21-22, which we just closed out in early August. And you will see, we'll talk a little bit about the transfers in a second because I have actual slide on that. But this is sort of shows our beginning balances, our totals, and our ending. Shows you all of the net activity in any one of those areas, whether it includes both general fund, the restricted fund, which is 03, all of our liability accounts. So OPEB, our property and liability, workers' comp, et cetera, is all expressed here. And then giving our ending balance totals, which remember, we always have to respect the 18% reserve. What we'll
So
talk
I have
about
a
little
question, Candace, back on a few pages back, if you
Sure.
could. So one of our revenue sources is this 8 million on behalf payment. Does that, and I guess it's only CalSTRS, it's not CalPERS 2, but whatever.
sisters.
Yeah, is that go directly from the state to CalSTRS, or does that go through a PCC bank account?
Directly to the state, or from the
Okay.
state to, yeah.
Great.
We
All
don't
right.
see it.
That's great. Okay, thank
I
you.
think the state likes it that way.
Yeah, but because you have budgeted it as a revenue, then I'm surmising that is there an equal expense of 8 million, or is it just
Or it's
part of our
7.9.
general
I mean, it's a
CalSTRS?
little bit under the 8 million, but yes, we show it as an expense.
Okay. Thank you.
So let's talk a little bit about the variance piece, because I'm John, we're very similar in that I like to sort of like, what are the major pieces? So Jesse did a really great job in the 311. I want to show what are the sort of main pieces so that we can kind of hone in on that and then ask any sort of additional questions. And so for me, as I'm looking for something, I sort of think about what are the variances? What are the real differences between what we projected in our actuals, our budget, and then what were our actuals. And so if you look through, we've given the line items on each of the pages. So we want to always understand that the component around all of this HERF funding makes budgeting an interesting challenge, because not only are we offloading some expenses to go against the HERF grants, so we always have to try to project what that looks like and be able to calculate. And sometimes, you know, the crystal ball is out for service. And so we did draw down 1.984 million of CARES indirect recovery. You'll see that on line 8199 under the first part, but we had only, the actual adopted budget was a little over $600,000. So that's a significant sort of variance that we want to point out. We also do, so Jesse talked a little bit about that educational revenue augmentation. So in terms of our local lines, 8817 and 8861. So the 8817 is the revenue that came into the college was less than what we had projected. So it was down by $3 million. Now we'll see, you know, there's sort of like this, what do I want to say, dial. So we may see those funding sources in other areas. So if you look at like either the federal, local, the federal section, the state section, and the local section, right? And you look at our total income, what we had budgeted was about 186 million. So if you look at page 2, our total income, adopted budget was a little over 186 million. Our actual unaudited was 191, right? So that's about a 2% difference. So we're pretty on top of being able to project. The team is really great about sort of understanding the calculation. So being 2%, I mean, that sort of shift that. We're 98% correct in our revenue projections in terms of what we're getting into the state. So we feel really happy about those numbers. So even when numbers go down in certain categories and up in others, they tend to balance themselves out as it relates to the revenue projections. The one about the 8861, I'm going to actually punt to Jesse and have her talk to a little bit about our unrealized gain.
Can I go back? Can I pause on 8817?
Of course.
So, so explain to me again exactly what is educational revenue augmentation? Is
Just
that
the
no harm, no foul on FTES?
Yeah,
No, this is actually I remember we circle back to this each year. This is our ERAF funding, and this pot of money is actually managed by, this funding source is managed by the county. So it's related to the property taxes around the region. And it has to do with the redevelopment agency and all that work. And so the county does the calculation of how much each education district within the boundary can receive each year. So they don't disclose how much they are funding us each year. So what we do is we do our best job guesstimating how much it may be based on history. So if we look back last year, we actually budgeted so last year we budgeted a little high and the actual came in about 3 million.
We budgeted 10.9 and it came in at 7.8.
Yeah, and the year before, I'm sorry.
Back to my question, just to understand what it is.
Mm-hmm.
When the state closed down all the redevelopment districts, is this, and they took that money that was going to redevelopment districts and they parsing it out, is that what this money is?
That is absolutely what this is.
Okay.
Yeah, and we kept hearing that it's going to end, but we just kept having money to come in.
Okay, so now I understand the concept of what it is, and I happen to have this page up on the detailed budget you gave us, and as I mentioned, last year we planned for 10.9 and only got 7.8. These things happen. what concerns me a little bit is the 22-23 says we're going to get 11.2. So why do we think we're going to get so much more next year than last year? And how long, back to what you were saying about ongoing funding? I mean, when they took the redevelopment money, that wasn't an ongoing funding, was it? Wasn't it a one-time take, or?
We actually, that's a really excellent question, Trustee Martin, and I'm going to try my best to answer your question. So we actually have been getting this funding annually. So, and we have not heard of any end date just yet. I mean, there's talks among in the field that is going to end for several years already, but it continues to come in. So what we did in this time around is that we took our historic and then kind of average it out into a 5-year trend, and then plus a factor of what property tax normally grow. So I can't recall what the percentage that we apply to exactly for this time around. So, but we will continue to watch this figure throughout the year as we get more information. So we may report when we meet throughout the year and say, hey, this number, we may need to adjust it up or down in one of those ways.
Is the source of this funding a one-time fixed source from when the state took over all the redevelopments across the state? Or is there some ongoing revenue that's flowing into this fund that allows them to keep allocating out to districts like us every year?
Yeah, that's $1 million question that we would like answers to. And I actually have been trying to find information, and I remember like when we ran into this question last year, I was doing all kinds of research, but at this point we have not had any type of clear answers.
So your 11 million two for the adopted 22-23 budget in this category is based on a 5-year average.
Correct.
And
plus a percentage increase on, we also added or layered on top of that some increases in terms of property taxes. But we can get you more details on how we projected that number.
okay, and I guess I'm just concerned that the gap between what we're budgeting next year and what we received last year is something, looks to me like around $3.5 million. And so, you know, unless you have good intel that we're going to get 11 million too,
Mm-hmm.
you know, I'm not hearing good intel that the 11 million too is a good number. And
Well,
it just scares me a little bit when we only got, you know, 7, 8. I realized the year before that we got 10.3. And it also concerns me because we're not even clear if this is a one-time fixed amount of money that's slowly going away, or if there is some refresh to the income into this fund that allows it to keep flowing out to us.
Yeah,
that number concerns me.
Okay. We certainly we'll get our Sherlock Holmes hats and also reach out to others to see if it's just a very difficult sort of category to project and actually even get a lot of clarity, you know, from, but we will certainly work to do that. I will say that even with the variances there, it's still within sort of that 2%, right? So the difference between even what we did last year still kept us within 2.5% of our projections, because other categories often run over too.
Yeah, and I get all that. It's just that
it's bothersome. It doesn't make
it's troublesome with the vast amount of uncertainty that's there to see the budgeted number going up. That to me is not quite as cautious as I would prefer.
Okay.
Because certainly it's easier at the end of the day when, oh, by the way, we got an extra couple million more than we really thought from ERA. We got to figure out what to do with it. That's a problem, but it's a problem you want. And not, oh, by the way, we're 2.5 million down because the ERA came in like last year. You know what I'm saying?
Right, yeah,
So,
yeah.
okay,
Okay,
I
we'll dig into
appreciate you
that a
looking
bit.
into that one a little bit.
Yes,
Thank you.
we'll dig into that a bit more.
Okay.
Jesse, do you want to talk about the value on our cash in as it relates to LACO 8861?
Sure.
That's a
So-
new one. The reason why it's here is because it's new. We didn't report this last year.
So it's a new GASB standard. GASB is generally accepted governmental accounting standard. So the new standard is requires that the district to actually realize what would normally be an unrealized loss on the cash pool to be a realized loss in the cash pool. So what we're doing here is that the Department of Finance provide us with a percentage of what our cash is actually worth because of all the investment loss in the market recently. So that number actually dialed our cash value down. So our dollar is no longer a dollar. Our dollar is 90 somewhat cents. So what you're seeing here is an entry that we recorded to realize the loss in fair market value in the cash pool. And then
I
so
think
this
what
will-
I just heard is the cash pool isn't in cash.
so our dollar is still a dollar, but the value is no longer $1.
Yeah, but that must be the case, right? The cash pool must not be really a cash pool. It's some other kind of fairly liquid investment pool, but
Possibly.
The first time we've reported this, at least in recent years. So when years are great, you'll see positive sort of points on this when the market is really strong. So we just wanted to make sure that we pointed that variance out so that there was some awareness to it.
no, I appreciate it and I get it. I guess I'm just, it's just the wording.
Yeah.
It's just the wording that
It's troublesome.
unrealized loss on cash. What? Isn't that an oxymoron? All right. All right.
Another sort of piece that we just wanted to point out is the inter-transfers in the 8980. So there was about a little bit over. So the first sort of federal funds was on the federal funds, and that's where we record our indirect costs, which you saw it in 8199. We also record interfund transfers in. So our CARES reimbursement for loss recovery also hits us here in line 8980, and we were able to recover 2.3 million more than what we had projected. It's over our estimates. So that's sort of the income pieces that we wanted to point out. As it relates to the expenses, now let's talk about the expenses. So the overall expenses for academic and classified salaries are still down. We're still seeing some impacts in terms of enrollments and the numbers of not only instructions or even some of the classes that were at 50%. We're also seeing that on the classified side that it's tougher. We've all heard about the recruitment challenges that are happening in the market, and that impacts us too. And so jobs are staying classified position, or managers positions are staying open longer, and so we see those expenses not cost us as much. The cautionary tale about those is that those are budgeted positions that have so as our enrollment will increase, because I'm just going to call it out, we're going to increase, and we're working really, really hard to make some movement in those areas. Those expense numbers will start to go up, and so we're cautious about sort of saying, oh, that's just money to be had, because it isn't. Those are positions that actually exist and need to be funded in order for people to fill them. It's just we're having some challenges doing that, not only in this market, but also with classes now we have, more classes that are at our percentage, our occupancy is higher. So it's at 100%, whereas previously it was 50%. Supplies and materials, we were able to
Okay,
dial
wait,
that.
can I have some
Yes.
questions on that.
Yes, of course, sir.
Okay, so when you say it's down 10.6 million,
Expenses.
I got it. Expenses down 10.6 million. What is quote down compared to what?
What we
I'm
budgeted.
assuming it's academic classified salaries in the adopted 22-23 budget is the subject,
Correct.
and it's down 10.6 million compared to
The adopted budget. What was budgeted for that line
in 21-22.
in 21-22? Correct.
Is this 10.6 comparing adopted budget 22-23 to adopted budget 21-22?
All within that same fiscal year, 21-22. So what we budgeted, so if you look, we'll go to our slides, our actual report. If you go to page 3 and you see the total academic position, what was adopted budget for 21-22, and then the actual unaudited, you'll see 81 million was adopted budget. And then you'll see the academic position, 74 million in expenses. If you add also, if you go to the next page, 4, you'll see our classified salary, right? And you'll see
Yeah,
what
and
was
there's a total line, total salaries, 114 and 103.
114 is the total between both academic and yes,
And
yes,
103.
is the actual
And
expense.
is that the 10.6 that you're referencing here?
Correct.
Okay,
That's
that's the
that
context
helpful?
I was trying to get,
Yes,
to which the budget that we're being asked to approve now is up to 120.
and the reason why that is, there's a couple things. So our fund has increased, like, so we have to account, we have to meet our faculty obligation. And so that's not something that the district cannot plan for from a budgetary standpoint. So the numbers that get calculated based on what we would recruit and hire get included in that higher number.
Okay,
Make sense? And then
Yes, yeah.
the same sort of concept for supplies and materials and services apply here. That same logic. We were just pointing out where what we did, I think, really well was to dial in our supplies and materials, because the previous year we were millions of dollars where the expenses didn't match the adopted budget. And so we were able, so this is just to show you on that line, I think we actually were able to make some adjustments to $300,000. We're okay with that. Where there's some services over overall expenses continue to report to be down. If you go to the final page on that is on 8. And so you'll see the difference between the total services, and it's spread all throughout. So there's not any one particular category that you can really pick on per se. Some are over and some are under. And so we're working to really try to make some adjustments based on that. But the thought process here in terms of continuing to budget is that, again, we have more services and things that are on campus that cause all of these things to go up. For example, our heating and oil and gas, our telephone, our water and electricity. So that's reporting on what happened last year. And so we have to manage the fact that those numbers are there, and in some cases are going up. And so we want to make sure that as we continue to bring folks back to this very happening campus, because my goodness, there's students popping around here. That's what made me a little late today. So I was helping somebody find their class. That we're accounting for the fact that the more leg traffic on this campus is going to impact these service numbers. But we do want to show you from last year where we were down in expenses.
okay, thank you.
We okay to go here, Trustee
Yeah.
Martin? Okay.
Yes, sure, go ahead. And other
right.
trustees, feel free to just jump
Yes,
in.
please stop me. Okay, so this is, this is the exact same slide that you saw just a moment ago, 2 slides ago, but this one I really like to dial in and talk about when we're making transfers and contributions out of the unrestricted general fund into other funds. So it's important that we talk about those things. So there's a total of 19, and some of these we actually really anticipate and plan for, and then we show them as transfers at the end of the year. A key component of that has been the strategy, although we have a new strategy on OPEB and our so our OPEB line 64 and our property and liability services, which is fund 62 and 64, we always pre-fund those liabilities for the next year. We have a new strategy when we talked to you about today, but we pre-fund it in order for us to make sure that they're covered in the next fiscal year. And sort of, it's like our contribution. These are things that we always need to account for. And so it's been our strategy, and it's a solid one that we work through. So there's about $4 million there between the two lines. There is a significant capital outlay fund transfer, which is important to note because we earmark projects that really need to happen that are compliance-based issues. So a portion of this funding that's being transferred is to cover gender-neutral restrooms and lactation rooms, which are compliance issues on this campus that we have to address and come to some terms on. But some of those things cannot be covered under deferred maintenance, and they're not necessarily sort of bond relatable activities. And so we want to make sure that the district is making good decisions about how we can fund some of those pieces in the future, as well as continue support for Serafi and overages that we see, and just construction in general, given the market and the up in inflation and all of our costs in terms of supplies and materials. So that's a piece. Everything else is sort of the normal transfers. I mean, we normally transfer to capital outlay, but the other two, the Fund 71, that's our sort of bookstore commissions that we always earmark for our associated students that we transfer out of the general fund to trust and agency, and then a larger trust and agency contribution from some commissions that go into the Centennial Fund. So let me pause and see if there are any questions.
Well, my only initial comment on that, and it's a question comment, is so we have a couple different huge funding needs besides capital outlay. We obviously have a tremendous STRS and PERS liability that needs to get funded.
I promise to, can you hold that for the next slide?
I can, but my point on this is, if there is any part of that capital outlay where our foundation, which recently received quite a bit of money, might find a project, even if not desirable for a state, for, voter bond fund, but understandable to a smaller group of well-educated people that know PCC, that contribution from the foundation covering some of those kinds of projects might free up some of that money to fund some of the liability that the foundation is probably not interested in funding. And so that's my only question about all the things that you mentioned there in that 15 million.
I'm gonna assume you're meaning the Mackenzie Scott funds.
Well, I'm referring to the foundation in general.
Okay. I'll let Dr.
I'm just saying the foundation in general.
Okay.
And sometimes there's projects that a foundation are of capital nature that foundations would appreciate funding.
Well,
That
Trustee Martin, we're
a little bit for things that they don't appreciate funding.
Well, Trustee Martin, we're doing that right now with the Advancing Science campaign, and that's to pay for FF&E and other things in the Serafian building that are not covered under the construction costs.
Great.
And the goal of that is to raise $4 million. We've raised a little over $2.5 million. So there are projects like that the foundation does contribute to some of the impact campaign as well. So yes,
Okay, well, you get my point.
Mhm.
I wasn't gonna go into detail because we didn't get a lot of detail other than gender neutral bathrooms, which are important. I get that. But, okay, I'll
Serapian.
hold the rest of it.
All right, but let me tell you, we always think about the irrevocable trust. Trustee Martin, we always
Right.
do. So a new strategy that we're going to start to employ is also to, in order for us to really sort of have the total cost of ownership of running this college, what we want to do is start to plan for budgeting, instead of always pre-funding, actually include within the budget year, the OPEB and the property and liability contributions or trusts. So the positive is this is our first step towards that. We've earmarked 2.3 million to be transferred in, but since we pre-funded, we're going to earmark this funds to go to the irrevocable trust, which we can pay out of Fund 64. So sort of like the clear, since we pre-funded 2 million, which will cover, yes, we're starting to budget for it because we want to keep that line within the fiscal year. Because what if we didn't have that money available to us to pre-fund? So we want to really start budgeting those liabilities within the fiscal year. But since we pre-funded, this funding that's there, that's going to be transferred in or budgeted, is going to be used for the irrevocable trust, 2 million of it, at an appropriate time where we should put it into the market and where we feel really good about it. But yes, it's earmarked for the irrevocable trust. So in the last 2 years, if you think about our contributions, we've contributed between last year and then this contribution, it'll be an additional $5 million to the irrevocable trust.
Thank you.
You're welcome.
And though there are obviously greater minds than mine that can tell you how to time these things,
Yes, yes.
I will just say from a psychological perspective, if you dollar cost average across the period and you do it steady and consistent,
Mhm.
you can sleep at night.
Yes, we want to sleep at night. So we agree, and we'll figure out when's the appropriate time to enter that. But I just wanted you to know specifically that that's been earmarked for the trust. All right, so we always report on our adopted budget, our positions between 2021-22 versus our projected positions for 22-23. So we're about 936 positions that are funded and accounted for. It's a little bit, what is that, 8 positions or so. I don't know why we get into the 0.77s and the 0.22s. I'm going to let greater minds figure that out. But it's about 8 additional positions. So we always report that. Let's talk a little bit about our HER funding and where we're at.
I'm really sorry.
Candace?
Candace?
Yes,
Candace?
yes.
Oh, I'm sorry. Can I just comment that the 8, are you talking about the 8 additional faculty positions? Or in general?
Just in general.
Oh, okay.
But you can talk, do you want to
Well, because
talk
we
a little bit
did-
about the additional?
Well, we did accept funding from the state to hire an additional 8 faculty positions, which we did the search for in the fall of 2021. And those
And
8
that's
people started in the spring of 2022. And, you know, there are some districts across the state, as I understand it, I don't know which ones, who took the money and still haven't hired people. So that might also explain why there's a little variance there.
Trustee Wang, did you have a question?
Yeah, I'm sorry to go back. Can you go back one slide?
Of course. This one or keep going?
Yeah, this
good here?
one. Maybe I missed something earlier. For the capital outlay, could you explain that sizable expenditure and net activity in this case? And then on this line?
Sure. So, okay. So anytime, so this slide is our projected fund balances of all of our accounts. So now it's funky. We sort of transition between talking about the unrestricted general budget, and then we throw you into seeing all of the different funds that we have. So in this one, So we started a beginning balance of about $80 million, some income that comes in. So this is usually that deferred maintenance that we get from the state, with expenditures being about 123 million, with the ending balance. So if you sort of net this all out, the ending balance of capital outlay is about 18 million.
Okay, and so the size of the expenditure is coming from
Like
what?
hundreds of projects. So we'll talk a little bit about when we get into strategic investments, but there's a ton of activity happening now on the campus, from things that might be $200,000 to things that might be $3 million, right? And so I do have some slides about what our top 10 projects were last year, that just sort of give you a highlight of how that funding is spent.
Perfect.
Can I just interject
Please,
slightly? Okay, so for the future year projected balance for what we're budgeting, a big bulk of it is the building for the Seraphim building.
Yeah.
Great. I figured, but I just wanted to check. Thank you.
All right, so talked about that, got that. Okay, so now CARES. We often get a lot of questions around the institutional portion and the student portion. And so we just want to walk through that at a high level. And there's a data dashboard that gets into specifics around what's being spent. So I'll make sure that that's included in Friday's board agenda, just if anybody's ever curious about what are the individual pieces. But just at a high level, so you sort of see this in sort of three buckets in terms of years. You have the ending balances as of June 30th of 21, the ending balances of June 30th of 22, and then what we've done since July 1st of 2022. And you can sort of see the spend down of that, right? So the institutional portion initially being about, right, you have this $64 million. You can see across the various spending grants. So some are federal, some are straight. You have the CARES Institutional Act, HERF 1, HERF 2, HERF 3. We also got funding the Minority CARES Act for minority institutions, HERF 1 and HERF 2 and HERF 3. And so this just shows each of the column are the various awards that we were designated, most of which are drawdowns. So we have to expend the funds before we can get it back. But I mean, needless to say, you can see each of the calculated awards that the district will receive under each of those grant categories, and then when we expended those fundings. So as of June 30th of 21, you can see the various expenses across that line, which totaled about $12 million and left us about $50 million, right? But then if you think about, if you go down to the next year, so 21 to 22, so as of June 30th of 22, so this year, here are then the red expenses that happened throughout the year, which totaled about $33 million. And some of this is salary dollars. I mean, we've been able to hire and bring on additional positions to help with CARES. There's some custodial positions that have been funded this way. There's some athletic attendant equipment that have been funded, you know, things that because of increased sanitation needs related to COVID, we've been able to offload those salary expenses here. And then, so you see then, so if we expended 33 million on those lines, the indirect cost of about 1.9, it left us at the balance as of the end of June 30th, 2022, with $16 million to go for this next year, okay? So we've also already started to expend those funds. We have, certainly we continue to support our students using UPass and free UPass, so transportation. Our bookstore credit has been extremely popular and great in bringing students back. Our materials fees, we continue to waive that, as well as our health fees. And so we'll see those costs in this fiscal year as well. And then employee related, we continue to make contributions on safety, ventilation, PPE, technology, and additional staffing. So this is the current balance of that institutional portion, that 13 million that we need to expend by July 30th of 2023.
I'm sorry, June 30th, 2020.
June, why did I say July? I just said July, just because, I don't know. My mind was thinking July. But June, thank you, Jesse, for correcting me. June 30th. So we got 13 millions to identify. And some of that is going to be, working sort of like what needs to happen between now and that June 30th date to make sure that we expend those funds in time. Because we've already received extensions. I don't know if they'll extend again. This is now the third extension. Second. Okay, so another one would be number 3. And so we're trying to be really diligently about planning that remaining institutional portion of the funding. But CARES has 2 portions, right? We have institutional portion and then we have a student portion. So let's talk about that a little bit. So the student portion is really great. And Dr. Levo and her staff have this algorithm and calculation in terms of how they go about expending those resources every semester to help our students. And so they've done a fabulous job in being very diligent about us getting those fundings out. So the total award through the various grants was about 41. And this student portion has to go directly to students. Like it's not for us to determine. It's like based on a calculation in terms of greatest need in financial aid, they do a calculation to then give out additional funding. Dr. Oliva also has a pretty robust emergency aid program that also is helpful to students. And so you'll see that they have consistently spent down and gotten those funds to students. So by the June 30th of 21, about $13 million went out to students, which left us with 28 million. As of June 30 of this year, another almost $16 million went out directly to go to students, which leaves us about 12 million. And so we know that Dr. Levo and her staff will be planning the final distributions of those funds this upcoming fiscal year. Yes, sir.
Which funding source does the UPass come from?
The institutional.
Okay.
We don't take that from money that should go directly to students. We take that from the institutional portion.
Good question.
Okay. Thank you. I'm based on what I've been approaching you recently.
Yes.
This is.
You want to know which pool you're going to swim in potentially.
Thank you.
Yeah, that's a good question.
All right. So now let's just talk about really quickly about some strategic investments that the college makes this year. Last year, we focused on technology, equity, and facilities. And since those are like multi-year things, I didn't want to show you the exact same slides again because they're relatively the same in terms of expenses. So we thought, hey, let's also give you some guidance on the strategic investments that sometimes we get with our restricted funds because we don't talk about them in totality in lots of ways, and also capital outlay, how those funds are expenses based on Trustee Wayne's question. So let's just talk about, so the restricted funds. So if you go again to your report and get to pages, let's see, starting on page 16, 17, and 18, you will see a list of all the grants in the adopted budget for fiscal year 2022-23. And it's almost $200 million in funds. So what we wanted to do is simply show you. So the total funds that those 3 pages calculate at is this 193,151,000. It's significant. But the important piece of this is those are restricted funds. So they are meant for a particular purpose. There are lots of rules and regulations about how those funds are spent and also calculated and monitored from Jesse's team in our grants accounting area. And so we do a lot of work there, but we don't talk a lot about those because those are sort of, this presentation usually is really focused on unrestricted general fund. So we thought it'd be really important to kind of just call out some of the largest top 10 sources of funding for restricted funds. So if you look at it, of course, CARES is the significant portion of that. So 34%. So the 2 slides that you saw before, that 64 million and that 40 some odd million, I should say the institutional portion is shown here and demonstrated here. The important piece about that, and to call out this year and thinking about next year, is remember that funding source is going to go away. So we need to be thoughtful about then how we rebound for all of the sort of sources of and items that have been paid for using our CARES funding, which we're very grateful for. But we've been really thoughtful about trying to make sure that we're expending those funds on things that are not ongoing or may not be ongoing, but that is not always the case. And so thinking about this is just sort of note to self. We need to start thinking about where we are using funds, CARES funding for whether salaries or additional professional experts to come and help support technology, those sorts of things. Then we start having to wrap our heads around how the unrestricted general fund will absorb some portion of that. Could it ever absorb all of it? Absolutely not. And so we've been trying to be very thoughtful about what goes against this CARES funding. But it's just one point that I just wanted to make sure that we were all aware of. The other two largest investment pieces or revenue streams or restricted funds is really going to be what we call our Student Equity and Achievement Program, our SEAP programming, which is basically the orange, the 16%, which is student equity, and the credit SSSP fund, which is the 9%. So those are the two largest. So when we talk about SEAP funding, those are the two largest pieces that get blended together and then distributed to the college to do equity and achievement work across campus.
What is credit SSSP?
It's like our old, it's the older language that previously was used for our student success something program. What was it, Jesse? What was it, Dr. Andrew-Jonas?
It's matriculation, which became student success service programs.
Yes.
Under Jack
Student
Scott when he was
success.
chancellor of the system.
Thank you, Dr. Alito.
Yeah.
So those two pieces are key. There's also a non-credit SSSP. So I don't want to say that it just doesn't, the allocation doesn't rise to the top 10, but you will see it expressed in these pages here that constitute that $193 million.
And Candace, can I just make a point that
Please.
sometimes folks, when they think about our student equity dollars, our SSSP dollars, I mean, we have this is called restricted funds and it's a grant. And so, but those SEAP and SSSP dollars are institutional dollars.
Mm-hmm.
They are money. Those are funds that come to us based on the number of students we serve, the type of students we serve to do various things. And we don't apply for those in the same way like we applied for the NSF grant or we applied for, STEM grants and things like that. And I just want to offer that because I think sometimes people think, oh, this program's being paid for by student equity, so the institution isn't really investing in it. Anything that gets paid for by student equity and achievement, SSSP, DSPS, EOPS, all of those are institutional dollars. They're just restricted in terms of how we can use them. So I just wanted to clarify that.
Thank you, Dr. Andrew-Jonas. So yeah, so then you'll see, so again, I just wanted to highlight the fact that we rarely talk about pages 16, 17, 18, but this is just a representation of the top 10. And so you could see those pieces, which excludes, actually, I did exclude the LA Regional Consortium numbers from this, just because I wanted to be super focused on the programs that I thought you would see and have some awareness as to what the work was happening there. And then the last one, I did a top 10 of our capital outlay as well. So some expenses on the top funds outside of the Serafian building. So remember, so Jesse mentioned like a good portion of her funding goes to support Serafian. In various different ways. You will see like replace you building district funding. So there's two sort of sources. the replace U building versus the district funded is the difference that we're also seeing in some of the costs. So last year when we transferred funds in to help cover the institutions cost escalation issues related to construction went into the replace U building designation versus the replace U building district funded, which was the initial calculation versus the state match and then what PCC was going to have to fund. Of course, we have facilities renovations. We have some work in printmaking in our building, 520, 523. Those were large investments. Health science division, we own properties. So if you didn't, trustees, if you didn't know, we're also land lords, good ones though, really great ones. And we have great properties around the campus that the district owns and manages and rents out to members of the community. There's some new work that's happening on to support, we call it the Octagon. It's this new special athletic equipment, which was a large funding source. We did some demolition that this power distribution plant wasn't needed to be managed by the district, but wasn't funded under the Serafian building. And so we did some demolition there, some parking lot distributions, and the actual work to get the infrastructure ready for the U building and the new STEM building is under that power distribution center piece. So it's sort of just an expression. While there's 100 projects on that list, we wanted to talk about really quickly, just again, what investments the college makes that expends. And these are not deferred maintenance types of items. So that's also why we make transfers into capital outlay to help with projects that can't be covered there. Woo! There you go. Do you have any questions? And how can we help?
Okay, I'll lead off with the questions
Yes, sir.
and others. So I'm back on unrestricted main adopted budget, because at the end of the day, this topic is next year's adopted budget for 22-23, and the history and variances and everything else is a very important part of it. My next question would be where we're under, and I don't know the term you use, I call it no harm, no foul, FTES, at the moment in 22-23 with the state. So there's some base FTES apportionment that we're going to get funded for, irrespective of the number of students we have, if I understand that correctly.
That's correct. Mhm.
And is that part of the general appropriation in that particular revenue number?
Yes, we are continue on this fiscal year under hold harmless.
Under hold harmless is the term you use. So probably not on this page, maybe the page before this, or back on the revenue pages, when we're looking at that state apportionment, 174 million, part of that is the hold harmless. Is there, we know we have hold harmless for 22-23. Sounds like that's pretty certain.
Mhm.
Is there any certainty around 23-24?
Yes, so the hold harmless provisions, and Jesse, if you correct me if I'm wrong, it goes, so we get it till 23-24. Is that our last?
Yeah, that will be our last. So 23-24 will be the last of our whole harmless provision. And so 24-25,
The new base.
We'll create a new base in 24-25. So in this particular year, 22-23, we have the whole harmless. In addition to the whole harmless, we also have what is called the COVID emergency provision. So that also give a little bit of bump for us too.
That's that block grant that we applied for.
That is the block grant is separate. So the provision is the application that we submitted to the
Just on the September 1st, yeah.
Correct.
I was noticing in our adopted budget and on page 3, and again, I'm referring to the I call it the detailed adopted budget. I'm sure you have a more detailed adopted budget than this, but and I'm looking at academic salaries, and in particular, looking at instructional adjunct hourly, where last year's budget was 25.6, the actual was 21.9, and next year we're budgeting 26.8. And I would be guessing that if our FTES doesn't make a dramatic increase, that we may not be able to allocate all the sectional classes that we had hoped. And that may account for why we were almost 4 million under what we had budgeted for instructional hourly last year, and may have some impact that we are not planning on happening for in the 26.8 for this current year. I don't know if that question was clear. But-
Yes, and one thing that we have to also be thoughtful of is, as the district is considering and as the board of trustees is going to help sort of give some guidance on any of the negotiated items, whether it be schedule increases or COLA, like we have to take that into consideration as
Sure.
well as we determine that number.
Yes, and that makes
That's-
sense, going from 25.6 to 26.8.
Yeah.
I guess the underpinning of both of these questions that I'm asking is, I don't want to sound negative and say the sizable decline of our student enrollment, but we know across the state, I don't know the exact number, about a 33% decline from pre-COVID in student enrollments. And it seems like that is going to would have some impact on our 22-23 budget. Apparently, it will have a tremendous impact if we're not back to normal, or what we are used to be calling normal,
Mhm.
by 24-25. Also, identifying some of the demographic challenges that we know exist, just looking at our high schools
Mhm.
and the declining high school populations. So again, this is kind of a question, kind of a comment, commingle,
Mhm.
how that number one important trend of actual student count, how that is impact, how we built 22-23 based on it, and where the wiggle room is if numbers don't improve, like we're working very hard to improve them.
Yeah, we definitely share the concern. I think from a strategy perspective, as it relates to this year and even funneling into next year, because we're under hold harmless. So one piece is we're going to continue to be funded on our 17-18, depending on the category. Depending on the funding source, it depends on which year we're funded on, but we're not harmed at this point. And so I think our strategy was, we think this year is really going to be a year for us to recoup those enrollment losses. And Dr. Olivo and her team has done really great in trying to think of creative strategies around how we can have new ways in which we're connecting with students. Associated Students has been a great supporter in that. Outreach programs and things like that. And so we're really using this year to, we're very excited and hopeful, and we're using it, and we cannot be harmed yet. And so
Yeah,
I think your point is spot on, and it's pivotal for us as we get to those points when those provisions are taken away, that we're going to need to make some serious conversations if we have not recouped by that time. But I think we're all hopeful that we will.
And again, just at the highest level,
Mhm.
we know there's a correlation between recessions and student enrollment.
Mhm.
Hot job markets is inevitably, I guess there's a negative correlation there. When you have a hot job market, you have declining student enrollments, and there's a lot of prediction about a recession coming, though none of the current job-related numbers that are supposed to be contributing to that recession have borne any evidence of it. So, I guess I'm looking at this, and there's kind of this perfect storm in a year or two with a new base, with potentially declining demographic numbers. Whether that recession transpires, whether we're over by 24, 25 on a recession. Some of these big factors, which of course we can't control, and we're part of the national state, but to the extent that there was ever a time and place to put away some of the good times to get prepared for the bad times, this would certainly be it.
Yeah.
And I know that's difficult in a collective bargaining arrangements and in the present day, when you never know what the state's going to do next year.
Yeah.
But there's just so many big picture headwinds for 24, 25. If this was not a governmental institution, I would be strongly recommending socking an awful lot away to get ready for that rainy day when and if it comes. And if it doesn't come, that's just a blessing.
Yeah.
So again, it's kind of not really a question, it's kind of a comment. I don't know how to direct you to, sock it away, because that doesn't always work. But that's my greatest concern. It's not 22, 23, but 24, 25. So.
Yeah, and Trustee Martin, I think your points are well taken, and I think, the issue we have is we don't really know what anything's going to look like. I think we won't have a true picture of where we're headed in terms of enrollment for at least another year, till fall of 23. And I think it's just what it is like to come out of the kind of experience we have. I think the other issue is that the student-centered funding formula is in some ways settled, and in other ways far from settled. And I really think that we're going to continue to see tweaks to the formula. And, in some ways we might be a bellwether college, because if we're struggling, if we're trying to figure out what our enrollment picture looks like and how to stabilize and all of that, there are a lot of colleges that are on much less, steady ground that are likely to be in even worse shape. And obviously that's not something we hope for, but I think that what that hold harmless and what the calculation is and how it's going to work and all of that, I still think there's a lot that we don't know, and we just have to keep working over the next couple of years to be part of the solution as the state figures out what to do with that student-centered funding formula and with hold harmless, because there's going to have to be something, but I'm not convinced they even really know what that means.
Okay, other questions? What action do you need from us? Do you need a recommendation?
Yes, please.
I think that's you and I again, Alton.
Yeah.
Well, I'll move
And I'll
to
second.
recommend.
Yep, and I'll second. Any further discussion, comments? Okay, Alton, are you in favor? I'm in favor. So you got 2 votes to do it again at the board meeting.
Awesome.
that gets us to proposed meeting dates. You have them listed on our agenda. To reiterate, November 2nd, 311Q. If there isn't something of more substance than just first quarter 311Q, I don't know that it's worth everybody's time.
Okay. Yeah, we'll see where we are at that point.
Yeah. Let me ask Alton as our new member, is the 6 o'clock time work for you or?
It's great.
Yeah, okay. And I think it's good for staff. I think that on Zoom, it's not an issue, all right?
Yeah.
So we will leave those as they are and give staff direction that if a meeting is not, doesn't warrant bringing people together, because I know that there's a lot of staff time and energy that goes into it. So if it doesn't, certainly as the chair, you can talk to me and I'm inclined to cancel. Proposed future agenda items? Any? All right. This was a little longer meeting than we normally go. We normally been able to nail it in an hour. Just a second, Eric. I'll finish my
Okay.
pontification, then you can.
Okay, yeah, I was gonna
Yeah,
pontificate as
so,
well,
but this
so
is
go for it.
because it's such an important meeting. I think of all the meetings we have, this is the one that's probably the most important. Okay, so now, go ahead.
Okay, my pontification is to say, yes, I echo that. And also to say thank you to Candace and Jesse and all of the folks they work with. This is the first post-HEDVA budget presentation. And so congratulations on that. A ton of work goes into this. And I think we're all very appreciative of what you and your entire fiscal team has done to get us to this point. So thank you.
Thank you.
Great. Yeah, it is. I know it's a tremendous amount of work. And especially with so many unknowns, I know you have to make assumptions and do those kinds of things and put it together the best you can. Okay, so I think that unless someone else wants to pontificate, I think that we will call this meeting adjourned.
Great. Thank you so much.
Thank you.
Thanks, everybody.
All right. Good night, everyone.
Have a good one.